Welcome everybody. I was reading my hat. Martinis with Scott. No, mornings with Scott. That's what we're doing right now. Hope everybody is going to have an amazing day. I started my M&A career, my investment banking career a long time ago. I'm old, probably in the early 1990s. And you would go to, as a young professional, you go to conferences, you hear people speak, you read studies, you get marketing material, all of which said that in North America, in middle market and small private businesses, there was going to be an M&A boom. M&A stands for mergers and acquisitions, means buying and selling companies. And as a intermediary, as an advisor, you make a fee off of doing that. That's your business, is helping people sell their business. You get paid more on the sell side than you do on the buy side, for sure. And so you read all these stats, and that what they said was that from demographics, from the aging population, you were going to have a boom in the merger and acquisition business. People get older, mostly guys in those days. They get older, and hang on, sorry about that. They get older, and they're going to sell their businesses, and there'll be lots of work for us M&A professionals. That's what they told us. And what I thought to myself was, that's not going to happen. There's no chance that that's going to happen as big as they are suggesting that is going to happen. What is going to happen instead is that there's going to be a troubled company boom. Now, why is that? It's because there's never this, what I think of in the business, decades later, there's never this why now moment. There's never this driving force that tells a business owner or an entrepreneur, now's the time I need to sell. I'm getting older. I need to get out. I need to have a succession plan, whatever that might be. It just doesn't happen. It just doesn't happen. I can deal with it tomorrow. I can deal with it next week. I've got the appointment with the accountant 6 months from now, and things get pushed off until the business starts diving down because the business owner has mentally checked out, the entrepreneur has mentally checked out. That was my hypothesis. And I think in truth, it's come out somewhere in between. I think there has been lots of private family business transaction work for professionals that are interested in that sort of work, but there's also been a lot of companies that have gone down the tubes, so to speak. Um, that was a political term used in the US yesterday, so I have that expression on my mind. It's gone down the tubes for because of a lack of succession. And so for example, I think this is again way back, maybe the 2000s, had an automotive client in the stamping and tooling business, and they were trying to sell because they were in significant financial difficulty with their bank. Well, why were they in financial difficulty? I mean, the industry was changing for sure. Tooling and stamping was moving offshore, not in North America. You could do it dramatically cheaper there. The business was dying here. That's all true. But also, the business had been pouring money into this business owner's entrepreneur's pocket for decades, decades, and he was now 81 years old at the time that I met him. And he'd never gone around to selling, and he never got around to training his only son to take over the business. And everything was gone downhill really dramatically. He was not in a frame of mind to to operate the business and meet the challenges that were coming to him. Okay. By the way, 81 years old, terminal cancer, also had an 18-month-year-old. I mean, this guy was living in a different world than the rest of us. And so that's what happens. Business owners are not good at figuring out their transition. Did you know that only 2% of new businesses, those of you that listen to my podcast forever will know this stat, but only 2% of new businesses will ultimately create wealth for the entrepreneur. 2%. That 90% of businesses fail in the sense that they never, ever, ever, ever pay their founder a living wage. It's one of the drivers of why I try to do content, is to provide some value to business owners and entrepreneurs so that we can improve those statistics. But the 2% are the ones that had some success and did a transaction, that were able to transition and take some money off the table to pay their mortgage and put their kids through college and leave an inheritance, right? I mean, that's it's such an astonishing small number. Well, in episode 237 of the Winning Momentum podcast, you can go back on YouTube and look that up. You can look on wherever you listen to audio podcasts. It should be published, Spotify, Apple Podcasts, all those sorts of things. Episode 237, which was a few episodes ago, a few weeks ago, we dove into this book, The Fail and Feud. And if you're on the audio version, you will be able to see the book that I'm holding up to the screen, but it's The Fail and Feud, spelled P-H-E-L-A-N, Feud, written by Stephen, with a P-H, Stephen Kimber. And we drove in. This is a dramatic, I mean, seriously crazy, true story of the Phelan family who built and battled over one of Canada's largest food services empires, Cara Operations. And when I say largest food services empires, I forget the actual statistics, but they controlled like 80% of all food in the skies at one point. If you were traveling in Canada, Toronto, Montreal, Toronto, Vancouver, anywhere across, there was like an 80-90% chance you were eating food serviced by Cara Foods. And when you ate in the terminals, they owned all those restaurants too. They provided all that food. And they owned or own still, I don't know, Swiss Chalet and Harvey's. Swiss Chalet being a rotisserie chicken restaurant, and Harvey's being a flame broiled burger place, both of which are really good, and both of which I grew up on, which is what really twigged me and my interest in this book, The Phelan Feud by Stephen Kimber. Okay, Stephen Kimber, yeah, Stephen Kimber. When I hold it to the screen, I have to read it backwards. So that's a talent that I can do as I'm drinking my first coffee here, I've just learned. Good morning, by the way. So we had the special guest on episode 237. Go listen to that, please. Stephen Kimber, he takes us through his new book, and it's the power struggles are crazy, and you have exactly this issue, this lack of succession by a patriarch family member that I have talked about, and everything I read and looked at is that this is a real life example that rivals and parallels the HBO hit series Succession. Okay, you can find that all in this book that is available everywhere you buy books. So we did this show, and then I didn't promote it. Not only did I not promote it, but I released it heading into Canada Day and July 4th in the US. So right into a weekend when no one's paying attention to podcasts and to my show. And that's all my fault. But as we were recording the show, literally as we were recording the show, I had a family member go into the hospital in an emergency. And those of you that's been following my media and stuff, you'll know that I had to zip from the west here where I am to Detroit area and deal with that for a week. And well, more like 10 days. And so I just panicked to get this show out, and then I haven't promoted it. So today is the day that I start telling you about this book, in fairness to Stephen for using his time to come on the show and do the episode. In the book, you're going to learn about Paul James Phelan's leadership. Paul being the patriarch who really enjoyed drinking because as you get older and you're enjoying the wealth of having of the business that you have grown or created. He didn't actually start this business. He inherited it from his father. And so there was a succession plan there, but he took it to new heights. It was incredible, the success that he had with the business. And you're going to learn about how he grew that business, his reluctance to transfer control. And he had three daughters and one son. And the Out of the three daughters, two of them had more or less checked out, and he had one daughter, Gail. By the way, this book was commissioned by Gail. This Stephen Kimber is an investigative novelist. Is that the right thing to say? He writes fiction and nonfiction. This is nonfiction, of course. It is a true story, but he does it in a storytelling way with just an incredible amount of detail associated with the book. And so, and so there's really a framing right off the bat of girl versus boy, of the sisters versus the brother, because of course the patriarch wants to transfer the business to the brother, to the next generation, when the brother initially wants nothing to do with the business. And Gail, the sister, was basically groomed, and she felt perhaps under false pretenses, but basically groomed to take over the business. And then she wasn't getting the business because he wanted to give it to the son. So there's this sister versus brother thing, which is probably, well, for sure is a real thing from that time period. I don't know that it's still relevant anymore, but there was other prominent families. By the way, these were a Toronto family in Canada, and obviously the very high end of society. There's all sorts of really cool Toronto history and the financing and purchase of the Toronto Maple Leafs. They didn't buy the Toronto Maple Leafs, but Harold Ballard, who bought the Toronto Maple Leafs, were financed by the by Paul James Phelan, and other cool stories about private schools and the shenanigans that go on, and substance abuse and sailing and horse racing, all the stuff you would expect from rich entrepreneurs that are grew up in that environment. And so, like I said, there's a battle between sister and brother, and in the end of this, well, I'm not going to spoil the end for you. You're going to have to buy the book and read it. There's a lot of talk about consultants, right? Whenever you have a bunch of money and conflict, you have consultants, advisors, lawyers, accountants. Everybody's taking a bunch of fees out. Everybody has different ideas. Everybody's going like, well, if you do this on one hand, you can do that on the other hand. And nobody ever does anything except for spend money. There's a lot of that going on. And there's a lot of just lessons of things not to do. As Steven says in the episode, don't don't do this. The main business lesson is don't do what these people did. Um, Intense family conflicts, a lot of drama. Anyways, it's a fantastic book. I really enjoyed it. I have not sat down and actually read a book in years. I listened to a lot of audiobooks. I felt like I needed to read the book for just out of respect for Stephen for having written it and agreed to come on the show. He didn't know me when he came on the show, and so that's it. The Phelan feud, and it's got lots of good stuff on there and good business lessons. I highly recommend it. Hey, investors, let's say you hear a pitch, an investment pitch, and you have some money. You want to put whatever, 100 grand, $1 million into something. You're a sophisticated investor, and I come to you and say, "Hey, I have a hedge fund. I have a hedge fund." And you think, "Well, that's cool." And I invest. What do you invest in, Scott? Well, I invest in various securities. So I'm buying stocks and bonds in the market, and also cryptocurrency. I'm buying crypto. And I have a structure, a magic structure, some people might say, for this fund, and it guarantees a 25% return. Think about that. 25% return. You can double your money compounded in less than 4 years. Amazing. Guaranteed, this investment, because of the structure that I have created for this hedge fund. This hedge fund is so popular, I've already taken in $6.2 million from 71 investors. Do you want to join me and earn this fabulous return with these 71 other people? There's the pitch. Should you invest? Let's think about that. Does that sound like a good deal? No, no, don't invest in that. There's so many red flags. There's so many red flags. Let's go through them one by one. This is a true story, by the way. I'm not just making this up. This was in the Financial Post yesterday. Cryptocurrency. Let's start with that. All right. Remember, I told you we're going to invest in securities and cryptocurrency. Cryptocurrencies are not an investment. Anybody who tells you that you can invest in cryptocurrency either doesn't understand or they're lying to you. It's a fraud. They are not an investment. I'm not saying people haven't got rich off crypto. Obviously, there's lots of crypto billionaires around, multi-millionaires, 100 millionaires, lots of figures, right? 9-figure, 10-figure. There's all sorts of that going on from people that bet on crypto. They didn't invest, they bet. Why do I say that? Because it has no value. The intrinsic value of crypto is zero. It has no utility. Utility speaks to value. Value, by definition, is the amount of cash after tax that I can put in my pocket in the future from this asset. What cash does crypto give you? Zero. It has no value. It has no utility. It's not a currency. Some people try to say it's a currency. It's not a currency. You can't pay taxes with your Bitcoin. You can't. It's not a currency. Therefore, governments do not accept it and recognize it as a currency. Therefore, its value, so to speak, is entirely dependent on what you can sell it for, which is entirely dependent on supply and demand. Are people trying to get into the market? Are there lots of bids? Are people trying to get out of the market? Are there lots of asks? And if the bids exceed the asks, the price will go up. And if the asks exceed the bids, the price will go down. Supply and demand, dead simple. That's it. There's no utility. There's no value. It's no different than if I said, "Hey, look, here's a glasses case for my reading glasses, and if for my reading glasses, and all of a sudden people want to buy them and people want to sell them, and there's a market created for reading glasses cases. I should have picked something that was easier to say and not a tongue twister, but there's a market created for this, and now we say, hey, I'm going to start a hedge fund to make investments in glasses cases. It's ridiculous. That's not an investment. Okay, it's like red or black on the roulette wheel. Maybe you'll win, maybe you lose. You have no idea. There's no value one way or the other. It's complete speculation. You give me $100,000 and my business plan is to invest that on red on the roulette wheel, and I guarantee you a 25% return. That's what you should be hearing. It's the exact same thing. And also, just by the way, why do you need a fund to invest in crypto? You can get your own wallet. Doesn't cost anything. You can go buy crypto on an index. I own my crypto through an index. What is an index fund? It's just a fund that buys a bunch of different cryptos and balances it and charges a very low fee, almost a de minimis fee. And it trades, so it's liquid like anytime I want. It trades on the market and it's regulated as a security, right? So I like that. It doesn't cost me much. It's dead simple. I just got to go buy that symbol through my brokerage account. I don't pay much in fees. I get marked to market every day. I can see what, like in real time, I can see what's going on every whatever, 10 seconds, is it? 10, 15 seconds, something like that. And I can exit anytime I want, and it's regulated. That seems to me to be a good way to buy my crypto. Why the hell do you have to go to some black box hedge fund and pretend that they're going to guarantee you fees? That's not going to happen. So there's red flag number one that you should have known. Red flag number two, no one can guarantee you 25%. That's just not a plausible thing to do. In fact, no fund can guarantee you anything. No legitimate fund is guaranteeing you a return. They have a hurdle, they have a benchmark, a target. Let's use that word. They have a target. Here's my target returns. Here's my historical returns. This is what I did in the past. The past is no indication of the future. That's what a prospectus says. But There's no guarantees. And how do you make a return, right? If you're a hedge fund, you want to make a good return. Well, returns are correlated, positively correlated, well, inversely correlated with risk. You can't make a good return without risk. And if you have risk, you can't guarantee a return. That's that simple. If someone guarantees you a high return on any investment, that is a sham. By the way, what happens if the fund doesn't make the 25% that's guaranteed? What happens then? Does anybody ever ask that question? No, they don't. Guaranteed 25%. Cool, I'm guaranteed 25%. Well, then what? Then what? What is the guarantee exactly? Are they going to pay you the 25% return even though the fund didn't make 25% return? Is that the way it's going to go? There's no guarantee. If he had the money to pay you the 25% return, he wouldn't have started a fund to invest your money, right? I say he because I'm foreshadowing who the problem that has existed here in this true story. So, if someone says to you there's a guaranteed return, you need to ask yourself, is this a sham and who's going to pay out that return? Some investments are guaranteed, okay, but they're backed and they make sense. You need to ask questions. I hear this in pitches all the time. Equity pitches on startups or, tech plays or high growth situations, and they guarantee, and if you're in Series B or Series C, they guarantee some sort of exit at whatever return in a year or 3 years. It's just a word. There's no guarantee. Where's the money going to come from if the business fails? Which, in all probability, it does. Do you remember the failure stats we talked about at the beginning of this? Of course, it's going to fail. So, who's going to write the check to meet that guarantee? There's nobody. There's nobody that's going to do that. It's not a guarantee. It's just BS and a good word to be used for marketing to entice you to invest. Red flag number 3, $6.2 million. That's not a hedge fund. In the fund world, they talk about AUM, assets under management. That's how much money my fund is managing. This fund had $6.2 million. And by the way, there's no hedging going on in this fund. So it's not really a hedge fund, but that's beyond the scope of what we need to talk about. The important part is if someone tells you they've raised $6.2 million for this fund, that smells of a sham. Why? Because break even on a fund is about $100 million AUM. They would have had to raise probably somewhere in the range of $100 million to earn enough fees to break even at the fund company level their expenses. If we think about it, so what would a standard hedge fund, private equity charge? I don't know. Let's say 1.5% management fee, and there's some upside fees from there. But forgetting about that, their baseline is 1.5%, which means if they raise $100 million, and that's the money they're managing, not 6.2 million, but $100 million, that's $1.5 million in revenue as a fee that goes to the fund. What does the fund company, the manager of the fund, well, what does that manager do? Well, to run a fund, they need, say, 3 to 5 smart people, and those smart people all need to earn, say, in the range of 200,000 plus. Let's say on average, maybe junior people are maybe 150, 125, but the senior people are making more. So let's say on average 200,000. Let's say 3 to 5 people. I mean, you're at the high end of that. You're approaching $1 million in salary out of your million and a half, right there, right? So, so that's a problem. And then you don't have just salaries. You have real estate. You have to have a lease. You have to have office space. You have to have a boardroom and cubicles and computers. You have to trade. You're a fund. You're buying securities. You're selling securities. You're getting into crypto, right? And so there's trading fees. You have to have databases to do research. You have to buy research reports. There's all sorts of fees. And you've only got $500,000 a year left over for that. So as you can see, you need about $100 million assets under management to even break even as a fund company. The math doesn't work. If you have a $6.2 million fund, that would be about $93,000 a year in fees. You don't have any money to do anything. So, what else are they going to do to survive but dip into your investment capital, not invest it, to dip into it for their own purposes? The pressure to do that is immense, is immense. So, if somebody comes to you and says, "Hey, invest in my fund and we're small, but we're growing. We've only got 30 million committed right now, but our goal is to get to 75 million." You need to run. They're not going to make money. It doesn't mean they're bad investors. It means they are not going to make money, which means things are going to go wrong. 100% things are going to go wrong. So those are the red flags. Well, sure enough, reported yesterday that Nathan Aikman, a trader in Canada, received a 4-year jail sentence after accepting millions of dollars, 6.2 million, from investors and then giving them false information about their returns. Shocker. He pled guilty a few months ago to fraud and trading securities without registration, who's ordered to pay restitution. According to the court, much of the money was used by Mr. Aikman for purposes unrelated to the business. In other words, he didn't invest it, he took it for himself to pay for stuff. Because once you go down that slippery slope, I think it's hard to stop, right? His partners found out and reported him. Here's another red flag for the partners. Aikman was the only person with access to the brokerage accounts, and his other partners could only monitor the fund's performance through a spreadsheet that Aikman created. Oh my. Listen, I hate stories about investors being duped, but honestly, they should have known better in this case. They should have known better. I doubt that they were unsophisticated. If he raised, I didn't do the average math on that, but it's probably got to be 300, 400 on average per person. So these people had that 300, 400,000. Should we do that right now? Should we do that right now? What is 6.2 million divided by 17 people? 364,000. Hey, I did a pretty good job off the top of my head. 364,000 on average per investor. So these are not, $5,000 investors. They should have known better. This is nothing more than greed. Caveat emptor. The buyer needs to beware, and you need to have some common sense. I once worked on a what's the right word for it? I mean, it was a file, but I was asked to step in to clean up in an executive director position to clean up a fund that was a fraud. And the long story short on this, because I'm running out of time, is that the some fellow back in the 90s, I think, had gone to jail for securities fraud. Now, back in the 90s, it was actually really hard in Canada to go to jail for securities fraud. And he got out of jail and immediately raised $80 million from private investors to start a new fund. Hi, I just got out of jail. Maybe they didn't have Google back then. I don't know. Anyways, he raised $80 million. And I remember specifically 67 million of that came from one particular family. And they were a very unhappy family about this at the end of the day. But he raised $80 million and then the money disappeared, of course, and he got into trouble again with the regulators. And so I ended up going in to part of this business to see what we can find out. And what we found out was that zero of the invested money was, well, I should have told you, their business plan was to take money from you at a guaranteed return. I forget what that guaranteed return was, maybe 12%, something in that range. And they were going to lend it out to private businesses that needed money at a higher return, like 16, 18%. So, guy gets out of jail. He's offering you a guaranteed return. And sure enough, things don't go well. And what we found out is that zero of that 80 million invested went to unrelated businesses. In other words, 100% of that money went to businesses that this guy owned or controlled in some way. So he just lent the money for himself. And then, of course, the businesses that he owned and controlled were funding his lifestyle, right? They were funding his big penthouse condo on the water and cars and trips and the women and all the good things. that come when you steal this sort of money. So, buyer beware, look for those red signs. I have a bunch more content prepared for you today, including our continued segment, financial literacy for business. But I've used up my 30 minutes, so we'll push that until tomorrow. I'm trying to do these at 8:30 Mountain time now that I'm back and stable, which I got back late last night. It'll be easier for me. I'm not doing it traveling. I hope you have a great day. Make some money, improve your business, and we will talk to you tomorrow.